This is Bloomberg Intelligence.
Spotify have always had fantastic user momentum.
Solar energy, the fastest growing corner of the energy market by far.
In-depth research and data on 2,000 companies and 130 industries.
The talent wars are right around Wall Street, but the buy side is plucking off of the sell side.
Aldi was the fastest growing grocery chain in the United States last year.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the housing market. You got home prices down year over year across most of the U.S., but there are some areas that are seeing some price rises. We're going to dive into what that means for mortgage-backed security valuations.
Plus, the WWE and UFC are now a single $21 billion combat sports giant. We find out what the future looks like for the newly joined brands.
Combat Sports. It's a new brand for streamers. Okay, but first, the small cap shares are trading at a discount, right? So far, that hasn't translated into real positive momentum. So what's it going to take for small caps to really get a strong bid here? Bloomberg Intelligence equity strategist Michael Casper joins us now. Michael, first off, what have small caps been doing and why?
Small caps have really been kind of stuck in a rut, and a lot of it is the regional bank crisis that's been going on. The regional banks, in fact, are about 10% of the index based on, GIC sectors. So that's really been holding the entire Russell 2000 back and causing a little bit of this rut that they've been in.
All right, so small caps, how do they typically perform in a rising interest rate environment? Because every risk asset's got to answer that question.
Yeah, typically it's a bit rockier for small caps. Usually when the Fed's hiking and doing QT at the same time, the only real example we have of that is from 2015 to 2019, just about. Small caps had a bit of a rocky period. They were up in fits and starts, down in fits and starts. Obviously, around 2016, when Trump got elected, they did pretty well. But that's really all we have to comp it against when you have both these policies moving against the small cap index.
Okay, so we have the rate issue, the inflation issue, and you have the bank issue. What about tech? I mean, I'm wondering, when tech overall in the broader index does well, because we're looking towards lower yields or a Fed cut, what does small caps do? What's the tech makeup there?
Tech in small caps is more semis focused.
But shouldn't that be a good thing in theory? I mean,
theoretically, yeah.
Okay.
And we're actually seeing a little bit of a spark there in fundamentals on the tech side. It's one of only two sectors set to put a revenue growth forward in 1Q, along with financials actually, which is benefiting from the high net interest income that we've been seeing over the last year or so. But yeah, generally tech and small caps more semis focused than the large cap component, and should be a little bit of a cyclical boost to it should tech kind of reflate here.
I don't think most people have a good call whether we're in a recession or heading into one. How do small caps do in that kind of environment?
Yeah, so recessionary periods, on average, the drop is about 40%, peak to trough.
Hurts.
Yeah, it's not great. And so far in this bear market, small caps peak to trough are down about 27%, which is in line with non-recessionary bear markets, by the way. And when we talk about bear markets, obviously any drop over 20%. So there's been 13 of those going back to the 1980. And the good news, though, is that typically small caps bounce back the hardest, and they outperform large caps by a pretty significant margin in the 6 and 12 months following the recession or the end of the bear market.
Right. So I was going to ask timing for that. Like, is it when the Fed starts cutting rates, or is it just peak to trough, or what?
So off the trough, typically small caps are going to do better. And usually
it's the timing that's tricky.
Yeah, it's the timing that's tricky. And if there is a rate cut, it obviously would be a good thing for small caps. And it's probably the next catalyst that I'm looking forward to for the small cap index, especially given that fundamentals are just looking so bad for most of 2023. And we're starting to see that kind of in consensus revenue growth numbers, right? So 2024 revenue growth for small caps is significantly better than S&P 500 revenue growth. It's now just a question of how bad do revisions get.
All right, so where are we in kind of the earnings risk issue for the small cap stock? We talked to Gina Martin Adams a lot just about earnings risk in the S&P 500. How about for the small cappers?
There's still quite a bit of earnings risk, right? We're seeing revisions cut consistently, and I'm more worried about a lengthening of this revenue recession in small caps, earnings recession in large caps. I'm more worried about the lengthening of that rather than the deepening of it, because investors are always going to position a few quarters ahead of any fundamental turn, right? And we're talking about timing on the rate cut and how that affects small caps. When investors are trying to time it, if the earnings recession or the revenue recession in small caps is lengthening, it just becomes a trickier question of, when is the right time to dip your foot in there.
What about margins? One could make an argument that these companies would be hit hardest by inflation. So if inflation's coming down, that would be good for their margins.
Yeah,
I appreciate the top line might not be so great.
Yeah, that's definitely something that was a concern in 2022. And we're starting to see signs of margin stabilization in both large and small caps. A lot of that has to do with being past peak inflation. But we also do some analysis on PPI minus CPI and how that affects company margins. And typically when CPI is higher than PPI, it should allow some degree of margin stabilization, because if you think about CPI, it's the output cost, right? So what consumers are paying for goods versus PPI, what companies have to put in to create those goods. So typically that's a good sign for stabilizing margins, and we saw that finally turn a few months back.
Industry segments, anything that you're keeping your eye on here?
So obviously, besides the financials issue going on, our sector scorecards that we put out for large and small cap generally like industrials, discretionary, and materials in small cap. And they're generally shunning the kind of rate-sensitive defensive. So if you think utilities and real estate, the companies that are kind of higher levered, it's a bit of an odd situation because obviously we're still in a bear market. The sector scorecard not liking defensives is a little bit odd, but I think it has to do a lot with that rate risk to those utilities and real estate.
What is defensive? I feel like it's a whole different conversation. We'll get you back for that. Michael, thanks a lot. Michael Casper, Bloomberg Intelligence equity strategist.
All right, from small cap shares to ESG. A lot of ESG funds tend to emphasize the E, putting more weight on environmental ratings and ignoring social and governance scores. For more on this and how this all impacts ESG investors open to risk, we bring in Bloomberg Intelligence senior ESG strategist Shaheen Contractor. So what are investors getting right and maybe getting wrong as we look at the ESG space?
Well, that's a good question. So, as you mentioned, what seems to be the most deciding factor we found is the E, and I'll specify very specifically carbon intensity. That seemed to be the most differentiating factor. Now, I wouldn't say that's what they're getting wrong, but simply excluding industries which are carbon intensive, in other words, environmentally sensitive, seems, what's the right word, lazy?
Well, it just is really limiting, right? Because your point is if you could have a company that was really good on the S and the G, they would still be excluded because of the E part.
Correct. And these companies, so there are a few companies that have ambitious carbon reduction goals. Even though they're pretty carbon intensive today, it seems to make no difference. It's just excluded. Like I think 66% of the S&P utility sector was included from these 15 large ESG funds we analyzed. 66%, that's a lot.
See, now on the G front, the governance, I have some experience in this covering media stocks because we always had dual class stock for a variety of reasons. The newspaper started it generations ago for the editorial independence, so they say. But that seems pretty easy to quantify, to measure, to score. Is it just something that investors are not worried about, or they just, I don't know.
I don't know either. It is pretty easy, right? It's literally just as your CEO, the same as the chairman. And we found that actually does lead to lagging returns. But if you look at board composition overall, doesn't seem to factor into ESG funds that much. In other words, companies that are in ESG funds have almost the same board composition scores as companies that aren't in ESG funds. Not the same, but not much of a difference, I guess, in other words.
How should ESG funds be thought of?
It depends on their strategy, which is a very vague answer, I know, but the way I look at ESG,
there's so many of them, right?
I know. So the way I look at ESG is what is material in terms of risks and opportunities given your sector. Now, the G can be considered a little more agnostic because, governance issues impact every sector. But for the ENS, it's very sector specific. I mean, I'm not going to rate a technology company on emissions as I am a cement company. So that's the way I think it should be done.
On the governance issue, I'm going to stick with that. Board composition is one that I always look at. So unfortunately, on the Bloomberg terminal, we have MGMT, management, so you can really get a look at who management is, who's on the board, what cross-board stuff do they have. So the information, thank you. Yeah. But that doesn't seem to be that big of a deal I don't hear about it a lot, people calling that out as an issue.
I don't either, which is probably reflected in this analysis where you see it doesn't make that much of a that much of a difference in ESG funds. That being said, I feel like governance was, the traditional sort of ESG angle where everyone said they're considering strong governance. But that doesn't seem to be reflecting in the numbers. I feel like now it's all about the E.
Right.
How's performance?
Performance, I think this year, let's talk about last year. Last year, we know performance was bad, right? Tech underway, energy overway, that fun stuff that was going on. This year, I've read articles on a little bit of a bounce back just because of tech. Now, I've not done the analysis so far this year, so still to come.
All right. So funds flow is another great way to get a sense of kind of where we are in terms of investor demand for ESG as a factor, if you will. What are the funds showing us both here in the U.S. and then kind of globally?
Sure. So when I think of funds, I think of ETFs. I use that as, a piece of the pie. So in Q1, the fund flows were approximately about 10 billion. Now, that's pretty low compared to what we saw last year. In fact, in all of 2022, we were at flows about 56% lower than 2021, which is quite substantial. And there, the US seems to be taking quite a hit. And we spoke about ESGU, which had this gigantic 4 billion in outflows, which pretty much occupies the entire chunk of the Q1 outflows. So it's the US sort of falling behind while Europe continues.
So what do we make of that? Is this reallocation to other stuff that has a better yield, AKA say money markets? Is this I'd rather go chase tech? Is this you didn't perform like I thought you were gonna? Is this just the mojo is leaving? What do you make of it?
So the real answer is we don't know. We can never tell why money is leaving a fund. We've picked up certain things from news, about 2 years back, this huge ESG ETF allocated to emerging markets sold out. It dropped its assets 90% because its largest investor sold out. And the investor didn't have anything to do with ESG. They just didn't want emerging market. So I can say that, the money going out of an ESG fund could go into an ESG derivative. It can go into an ESG separately managed account. It could go anywhere. The fund universe is not that, evolved.
It's just not clear yet
we don't know
what that is
going.
about, or if it's just shifting from product to product, which would make a difference.
Correct. And on that note, what we did see, I feel like that came today in the news, that there was this largest ESG ETF launch, about 2 billion, but that was just reshuffling between two ESG ETFs. So we can tell few things, but there's a lot we can't tell to make a reasonable emphasis that, all this money going out of ESG is because of ESG and ESG alone. We can't say that. Nor can we say it isn't.
Right. All right, Shaheen, thanks a lot. Super appreciate it. Shaheen Contractor, Bloomberg Intelligence, Senior ESG Strategist.
Coming up on the program, the WWE and UFC are joining forces. We take a look at the outlook for the new sports giant.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
The WWE and UFC are joining forces under a new deal. A newly combined combat sports entity, trade under the ticker, get this, TKO, and is already valued about $21 billion. For more on this and the outlook for the newest sports giant, we're joined by Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. So, Geetha, I know you're a big WWE and UFC fan, so I'm going to tap into some of your expertise here, but just give us a sense of why these two companies got together.
Thank you. Thank you so much, Paul and Alex. So size and muscle matter in the media and entertainment business, and that is really the key factor behind the combination. So I think there's a lot of strategic merit to the deal. Both of these companies, you have now a pairing of two of the biggest sports entertainment brands in the world. And so I think with their combination, they're both going to get a lot more leverage in media rights negotiations and licensing opportunities and cross-selling opportunities. So the transaction, to me, looks really like a win-win.
Why is this happening now versus, I don't know, a couple years ago or something like that? Why does this make sense in this environment now?
So WWE, their leader, CEO Vince McMahon, actually left the company a few months ago and then came back this year to kind of explore different strategic options for the business. And this is really a culmination of his efforts as the business kind of enters a new renewal cycle. So they have carriage deals currently in place with Fox, with NBC for some of their programming. But before the new negotiation started, Vince kind of wanted to have some kind of strategic options looked at, and it looks like this is what it culminated in.
So talk to us about the media rights, because I know for a lot of the other sports out there, it's such a big part of the economics, getting those TV rights and everything. Give us a sense of how important it is for WWE and UFC, and what all this cord cutting and streaming stuff means for this business.
Yes, actually, this new company is going to be a pure play sports media asset. And what is so interesting about the combination is that 70% of their revenue is actually going to be contracted revenue. So it's going to be from those TV and streaming deals. So both companies actually have streaming deals in place. WWE has one with Peacock. UFC has one with ESPN Plus. WWE also has TV deals with, NBC and Fox. And so, what really makes sense is that they are in the sports media business, which is one of the very few businesses, I want to say, in the media area, in the media space, which actually is seeing tremendous increase in value. We're seeing about 50 to 70% increases in sports rights fees every time a carriage renewal comes up. And that's kind of what these companies are now banking on. So with their combined might and muscle, they're really looking to kind of gain that upper hand in those carriage negotiations. So again, I think that's a really a big point for them. That's a really huge opportunity for them. Revenue synergies. The other big thing is we're looking at is cost synergies, and they kind of outlined about 50 to 100 million of cost synergies as they kind of combine very similar businesses. But we actually think they can extract more, once the integration is kind of complete. In terms of cord cutting and streaming, so WWE already has dabbled in the streaming world, so they already have a streaming solution. Of course, now they can have, again, with so much more content, with kind of an integrated offering, they have so much more to offer in terms of a streaming product as well.
And, I should point out that there are rumors that The Rock is going to return to WrestleMania. Like, I know nothing about this, but I love The Rock. Like, I will learn about it just for that guy. What's the role that Endeavor played in all of this? It was a different kind of setup here.
So Endeavor actually owns UFC. They bought, the Ultimate Fighting Championship a few years ago. And what they've done with the UFC has kind of been really, really amazing. They know the playbook. They've actually grown UFC's revenue from about 600 or 700 million when they acquired it over to about 1.3 billion. So they have a great business. It's an events business. It's a talent management business. But most investors felt that the UFC under the Endeavor umbrella was really not kind of getting the attention or the valuation that it deserved. And so now kind of splitting it out into its own asset and merging that with WWE kind of makes sense even from a valuation perspective.
All right. So when I think of the WWE, I think of Vince McMahon. And when I think of Vince McMahon, I think of the WWE. What's his role going to be in this new co?
Yeah, so he's actually going to, so Ari Emanuel is going to be the CEO of the new company, the one that's going to trade under the ticker symbol TKO. But Vince McMahon is still very much going to be part of the board. He is going to be heading up the WWE portion of the business. We're going to have to wait and watch and see exactly what role he plays, but he will probably be reporting to Ari Emanuel.
Are there other areas in... It's not sports, it's not just entertainment, the sports combat media entertainment landscape that can also merge? Like, who are these guys up against?
I think they're pretty much, this kind of creates a pure play, this combination. And I don't really see, there are some different businesses, but nobody really is in direct competition with them. So kind of, these were the two entities who were kind of in this mixed martial arts or kind of combat sports, if you will. There really isn't any other pure play as such.
And I noticed, I was looking through your research note, Geetha, and the valuation differentials, enterprise value to EBITDA, from some of the traditional media companies to some of these, kind of sports kind of deals, they're really, really differential. Tell us about that.
Yeah, so actually, if you look at this new deal and the new company, it has an implied valuation of about 20 times enterprise value to forward EBITDA. And that's substantially over the median value in the media space, which is about 12 times.
Wow.
And if you even look at it from both a WWE as well as a UFC perspective, for UFC, as we were just speaking, Endeavor, for instance, trades at about 13 times. So UFC was clearly being undervalued under that Endeavor umbrella. So I think this kind of unlocks some value for UFC as well. And with WWE, they too are now trading at about 23 times under this new deal valuation. So I think it kind of makes sense to us because, again, as we just discussed, sports is the fastest growing area in media. You have sports rights for both of these companies that are coming up for renewal, and we see a substantial increase in their EBITDA in just the next few years' time as those new deals go into effect.
How does this stack up with like Major League Baseball or something in terms of valuation?
So it's very hard to value Major League Baseball. First of all, they're not publicly traded.
But I guess if we look at it from like a revenue streaming standpoint, like what's the command? I'm trying to get at what the command power is for like WWE versus actual sports.
Whoa, wait a minute.
Oh, come on. No one's going to think that wrestling is an actual sport.
I did for the longest time.
Were you like 8?
Maybe.
Well, I would say valuations are pretty comparable if we kind of just look at financial metrics. So some of the other sports deals that we've kind of seen out there, again, we've seen valuation metrics in those high teens, in the low 20s range. And so this is pretty comparable. I don't have an exact metric on MLB itself, but again, very comparable to the other sports entities out there.
Really appreciate you taking the time, Geetha, walking us through this deal. Our thanks to Bloomberg Intelligence Senior Media Analyst, Geetha Ranganathan.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So home prices across most of the U.S. are lower, but there are some pockets, like in the South, where prices are actually rising. So what do these regional differences in the housing market actually mean for, say, mortgage-backed securities and the investing space? Joining us now is Bloomberg Intelligence mortgage-backed security strategist Erica Adelberg. Erica, what's the read-through between, hey, my house price is now worth 10% less to my actual mortgage to a mortgage-backed security?
Well, the read-through right now, it's an interesting time in the market because I think, as we've mentioned here before, so much of the mortgage market is held in very low coupon mortgage rates. People took out these mortgages when, rates were a lot lower, 2.5%, sometimes 3%. And a lot of those people aren't going to be that encouraged to move or relocate anytime soon. And they'll probably be even less motivated to put their homes on the market if they think the price of their homes is going down. And how that reads through is that the turnover rates, therefore the prepayments, the speed at which you get your cash back for these very low coupon bonds is a lot slower as a result. It creates some extension risk in terms of duration from a portfolio perspective, but it also just means that your returns will be lower because it's going to take a long time for you to get your principal back.
Something I learned but have since forgotten from a great financial crisis is this concept of prepayments. What is it, and how does it impact the value of mortgages, mortgage-backed securities?
Mm-hmm. In the mortgage world, in the U.S. mortgage world specifically, there's no real penalty for paying off your mortgage early. And there might be a few reasons you do that. One is if rates fall and you want to refinance. Another is if you are relocating. Sometimes you might curtail part of your payment, let's say, if just to pay less interest over the long term. Once you've sold your home, for instance, you might pay off part of your principal. So there are various ways to shorten the time frame that you have to pay interest. No matter what, you're going to pay less interest if you pay off some of your home early. So it's great that there's, some incentives to do so. But if you're only paying 2%, you probably have very little motivation to pay it off early. You're probably earning more than that in your money market account right now. So as a result, the mortgages will take, let's say you have a 30-year mortgage, let's say you're an investor, you probably have to wait, much of that 30 years to get your principal back. And if you only had like a 2% mortgage on that rate because you bought one of the bonds that was issued in the previous 2 years, let's say, then you're only getting 2% on that mortgage for a long time. You'd rather, in some ways, get some more principal back at par, have somebody relocate, pay you back that principal, so you can reinvest it closer to current rate, so it's just currently closer to 5 or 6%.
Or retirement. That's my goal. Pay off so I can retire. So for security, for mortgage-backed security investor, what a early prepayment looking like right now for me?
Well, from an investor standpoint, we are very close to the lows. It depends on what time frame you want to look at, but basically the lows of the last 30 years. Now, they did pick up a little bit in March with the start of spring seasonals, and rates did dip down just a little bit, which motivated probably a few people to be more willing to relocate. Purchase indices for loans did pick up. But basically, we're extremely close to, as far as I can tell, it's the slowest we've seen for a March prepayment in about 40 years.
Wow.
So if that puts things in perspective, we're not, we're a little bit slower in January, February because housing seasonals are extra slow then. But from a March perspective, it's very slow, and it's at the exact time you wouldn't want that from a mortgage investor, since most of the mortgage market is currently oriented in that 2.5% sector.
Do these fancy mortgage-backed securities bankers on Wall Street, do they make regional baskets of mortgages like in the South where it's a strong market versus maybe the Northeast where it's not so strong?
It hasn't been historically, that type of basket. In the Bloomberg Mortgage Index, for instance, we separate out just a few different geographic concentrations as having better prepayment characteristics, or worse in some cases, but usually better. For instance, Florida gets its own specification, so a lot of originators will, in fact, segregate out pools from Florida and ship them into a separate pool. New York gets its own concentration because it tends to be slower, which right now isn't actually a great thing because of mortgage recording taxes. It's always slower. It does help you when refinancings pick up. And then Texas gets its own bucket for historical reasons. Not sure if that's still that valid. But they don't actually bucket it so much, by region. And so one of the strategies we've been recommending is to look at some of these traditional specified pool stories. Like, let's say you can minimize your California exposure, because right now California homes are paying a lot slower than the rest of the country, the prepayments, because affordability is so low there. And with the, tech layoffs and things, the housing market's really taken a bit of a hit. So as a result, we're seeing very slow prepays out of California, which is normally a big part of the mortgage market. But if you can sort through and try to find, let's say, your higher California pools, ship those out into just to be announced type of, generic delivery, but keep the ones that maybe have a higher Florida, or not even a higher Florida, but higher South Carolina, higher Georgia, higher southern U.S. Concentration. You might be able to kind of for free, or at least low pay up, get, some better geographies. So that's one of the interesting ideas we've come up with recently.
So my question was, how do I boost a return? And it sounds like that's how I boost the return.
Yeah, that's how you boost the return, because then you're getting a faster prepayment on these low discount mortgages. And as a result, you're getting back more principal left, at par, which you can reinvest at higher interest rates.
Where do you think mortgage rates are going?
I think mortgage rates are probably, we think, by the end of the year, they'll probably be lower. Will they really be hanging out closer to 5%? I mean, it depends on if we rally quite as much as our rate strategist thinks. But there are a few impediments there for mortgage rates falling that aren't necessarily normally there. And they manifest themselves in a much wider primary-secondary spread. That is where an originator is willing to make you, consumer rate for your mortgage versus where things might trade in secondary markets, and also where things are trading in secondary markets versus treasuries. And both of those spreads are a lot wider than normal. For one thing, the originators actually have been, unfortunately, pulling off their first negative profit years in I think in the history of mortgage origination, at the end of 2022, with flows so low and employment rates still relatively high in that industry. And then you have credit concerns going on, at least, they're not necessarily seeing a lot of defaults in mortgages, but banks are beginning to be less willing to make loans. So that's what I mean when I say there's credit availability concerns. And, in order to be profitable, they're going to want a higher, lending rate than the normal. So both of these are going to mean that mortgage rates to homeowners, probably the consumer, probably falls a lot slower than treasuries.
So are they pulling back on lending growth because they just are and they're worried about the environment? Or is this sort of the aftermath of SVB, et cetera, and sort of just general fear or deposit flight?
It's both. And especially, for mortgages, it's called the Mortgage Credit Availability Index that is tracked by the Mortgage Banker Association actually hit its lowest rate since 2012 in February, and that was before SVB happened. And the print just came out yesterday or today, and it's equally low but not lower. So the mortgage lenders are already pulling back, and it's largely because volatility is so high and profitability is so low that it's hard for them to actually, hedge their pipelines, for instance, and be guaranteed of a profit. Plus, as I mentioned, profitability is very low. So the mortgage lending industry was already pulling back on credit availability.
Right.
But I don't think the SVB situation is going to help things much.
Yep. All right, Erica, thank you so much for joining us. Always appreciate getting your perspective on the MBS market. Erica Adelberg, Bloomberg Intelligence MBS strategist.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
All right, let's switch gears now from housing in the U.S. to office space in Europe. Office values in cities like London are just sinking, spelling some trouble for the commercial real estate industry and lenders. So let's get more insight here with Bloomberg Intelligence senior real estate analyst Sue Munden. Sue, there's a lot to talk about with CRE, commercial real estate, but let's say we just focus in London. What could prices fall, say, in the next year? What could be the downdraft?
Well, we've already seen a fall in prices in the City of London, at least 10%, probably a bit more. Collier's data would give us 17% in the second half of 2022. And so really you need to look forward and look at the risk premium to get a gauge on where we're going. So what's actually happened is that yields on property have only expanded on London office property, only expanded about 50 basis points, whereas we've seen 200, 300 basis point rises in the policy rates and in the 5-year swap rates. So on that basis, we could see the yield effect alone making London office property fall over 30% over the next 18 months. However, you've got to take also into account what's happening with rents. So if rents go higher, then that changes the math and obviously offsets some of the yield effect. So we were having quite good rises in rent, 5 to 10% in really, really good quality London office space in the second half of last year. So that's helped a bit to sort of muffle some of those falls. However, going forward, we might not have the same situation with the weak economy and as inflation starts coming out of the system. And on top of that as well, we've also got a much bigger problem in the secondary market for offices, because there, obviously, we've got much higher vacancy and, there may be much more distress on the margin.
How about other parts of Europe? I know it's a very small sample, but just some of the Brexit jobs that maybe have left London, gone to Paris and other European capitals. What are you seeing in Europe on the continent?
Yeah, actually, that's true. We have seen some banking jobs go to Paris. And in Paris, in the CBD, where there is limited space because you can't build above 7 stories, and we have seen rents rising there as well. And on top of that, on the continent, most of the leases allow for an index uplift in the rent, and that's an annual uplift, and it's based on an inflation cost of construction number. And so that's running at sort of 6 or 7% at the end of last year. We haven't had the first quarter numbers yet. So that will drive the earnings growth that they're looking for there. There are a couple of provisions. One is that small and medium-sized companies have a cap of 3.5%. So that will limit the increase in rent that they have to pay. And also, you can get a situation where if the inflation is quite high and the market's not moving with you, what will happen is that you're sort of over-rented, as they say. So, in other words, the rent that you're paying is more than the market rate. So the next time you get a chance to market, the rent will actually go down. So you're just building up a problem, kicking the can down the road a bit.
So when it comes to commercial real estate loans, for example, when does the wall of maturity hit? Like when does the reckoning happen when it comes to prices, when the cap rate winds up going up?
Well, I've done some analysis on this, and I've looked, most loans are, say, 5 years or 10 years because you're lending against a long lease. And so I've sort of gone back with the real estate data 5 years to look at what the values were then, and that would inform what one of the main covenants on a loan is, which is the loan to value ratio. So look at what they lent at 5 years ago, and also look at what the rent was 5 years ago compared to now. In London, it's the worst situation where the values now have gone down sort of around about the same level as 5 years ago, maybe a tad lower. In Europe, it's a little bit better, but it's still quite close to where it was 5 years ago. So there's not much space, but you're not breaching your covenant yet. And hopefully you'd have paid some off during the time as well. So you're probably still not too bad. On the rent in Berlin is up about 40% over that period, and in Paris up 20%, and again in London, not much. So, it depends where you are. But if you sort of look at it in those levels, where we are at the moment, I think things are just about holding together. There'll obviously be some distress on the margins, especially, as I say, where there's high vacancy. But if you then have another lurch down that I was alluding to earlier, then we might start having more problems coming in. I think, the banks would probably roll over the debt as long as they can service it properly. But where they can't do that, then we may have more of a problem. And also the appetite for lending from banks is obviously shrinking with the rises in interest rates, and the transmission mechanism works from the central banks.
So, Sue, Alex and I, we're here in lovely Midtown Manhattan, and we're kind of lonely. This back to work
That's
thing.
true. Oh my God, it's like a ghost town outside.
It is. This back to work thing.
Yeah.
I don't know. Maybe it's 50% in the U.S., but it's lower. I'm not sure what it is in New York, but it's not full. It's not pre-pandemic. How is it in London? How is it across the continent? What are you hearing from some of the real estate companies?
Yeah, I mean, the real estate companies are telling me that the States, especially New York, is really quite frighteningly bad compared with what we're seeing in Europe. More of us have gone back to work. It's a sort of 3-day work week, but nevertheless, it's sort of better grounded than it is in New York. And so the vacancy is high in certain places. I mean, above 10% in several of the sort of districts around London. It's certainly growing on the periphery of Paris rather than the very center. So yeah, I mean, it's slightly different here, but that doesn't mean to say it's not coming. We all know that if the rents go too high, the employers know that everyone can work from home, because we did it very successfully for 2 years. So, it's not like we have to have an office anymore. There are other choices. So the choices are becoming, maybe we'll have some co-working space, maybe we'll just downsize. And, those are possibilities as well. So we're going to see this sort of panning out over the next few years, I think. I don't think it is that quick, although we did a survey earlier this year, and 70% of the respondents, which were, employees rather than the employers, had said that their employers were either planning or had moved in the last 6 months. So, there is a lot of more mobility than you might think, but so people are getting it right, but still, yeah.
So if I'm a commercial real estate investor right now, what do I do? What am I doing right now?
Well, the larger, the REITs that I see, there's some transparency for, they've all been deleveraging. They've been trying to sell off assets to increase their liquidity so that their loan to value ratios are quite low. So 30%-ish. So there's a big cushion. A lot of them would tell you that they can stomach a 40-50% drop in values from here without testing any of their covenants. That route, though, is obviously becoming much more difficult because the transactions in the market have just evaporated between 40 and 80%, depending which city you look at. But I was talking to a CEO from Milan last week, and he was saying that it's more like 80% lower transaction volume. So you've got no real benchmark for valuing the property, and the buyers are obviously in one place and the sellers in the other. But also it's very difficult to execute unless you're going to take a really cut down price. So, that's becoming a much more difficult strategy. For the others, it's just really making sure that, your property is in the best, condition it can be, and keeping your tenants close and understanding what their needs are and helping them out so that you can work together to make the office space work and you won't then have so much distress.
Sue, look, we really appreciate it. Thank you so much, Sue Munden, Bloomberg Intelligence, Senior Real Estate Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney, and this is Bloomberg.